As Adam mentioned, obviously our business continues to grow and scale, and that's really an opportunity that we see as the banks continue to recede and cede market share, and obviously that requires a significant continued investment in origination capability. And as a result of that, we've now grown our team to over 150 people, and we're very active across those four key parts of the loan market. I think today what I'd like to do is sort of address head-on some of the commentary that's been recently reported in the press. A lot of scaremongering, a lot of negative headlines, a lot of misinformation. And I think when I look at all of these various articles, podcasts, commentators, I think it really comes down to four key themes. The first theme is really around macroeconomic risk or macroeconomic drivers. So private credit is growing. Must be something wrong with that, is the sort of catch cry. The second theme is really around poor or weak lending standards. The third area of criticism really comes down to weak governance, lack of openness, lack of transparency. And then the fourth area is really contemplating investment risks. So when I think about that, they're the four key criticisms. And what I'd like to do through this presentation is really highlight the fact that not all private credit, private debt is the same. It's not a homogeneous asset class. The asset class is very different. At one end of the risk spectrum, you can be investing in high investment grade loans to corporates. At the other end of the risk spectrum, you could be taking high yielding subordinated or mezzanine debt where you're taking equity kickers. There's a range of investment options. But really, the criticism in relation to the growth of the private credit sector really is missing the point. Australia does not have a large, deep, functioning bond market. Most Australian companies aren't rated by S&P or Moody's. They're heavily reliant on banks for funding. But as a result of the regulatory changes, the banks are continuing to withdraw capital from the market. It's not economic for the banks to use their balance sheets to lend for corporate and institutional corporate purposes. They're really skewing their balance sheets, and they have for many years, into more focus on consumer home loans and small and medium-sized business lending. So, of course, that creates a funding gap. It's a dislocated market. The regulatory position post the GFC has driven the outcome. And so what are we to do? Sit back and see a situation where Australian companies don't have access to funding? Of course, you're in a position to resolve that and support those companies with access to capital. I guess the other thing that comes out of that is this idea that we're facing into this global default cycle. You know, all of a sudden there's this massive wall of insolvencies. I think if you look at this chart, what it highlights is that those insolvencies have been predominantly in one sector, the construction sector. So if you think about it, we saw construction costs rise 25 to 30% from sort of around 2021. Obviously, if you're a small subcontractor and you've entered into a fixed price contract, you're going to be under a lot of financial pressure to deliver, given the rising costs. And so often the way in which they deal with that is obviously to put your small company into insolvency and walk away from that obligation, re-tender. So I would argue very much that the increase in insolvencies that are being reported is actually a lagging indicator, not a leading indicator. And so when you look at it, again, our area of lending activity in Metrics is primarily in large-scale corporate and institutional lending. We're not lending to small and mid-sized companies. Those small and medium-sized companies that have assets of less than $10 million have been the area of largest area of defaults and insolvencies. So again, I'm not really sure that that's a reflection on the kinds of private credit investments that we make. And I think it's really important that people do understand that difference. And I guess what I'm really trying to highlight is if you look at the target market or the addressable market of where Metrics lends, have the same exposure, same experience that the domestic major banks have. They're not seeing significant increases in loss rates. And certainly when you go back in history and you look at probably one of the most significant financial events in our lifetimes, being the global financial crisis, loss rates in Australia for the Australian banks peaked at 0.67 of 1%. Very low levels of loss rates. So this idea that private credit is exposing portfolios to significant risk of loss, I think, is misstated. Coming to the second area of criticism that comes through in the recent media coverage, poor lending standards. And so I guess, I would be the first person to say that the biggest risk that an investor is exposed to in private credit is the risk of a loss of capital as a result of a default and the failure of the manager to manage and protect the investor's interests. There are lots of ways that are available to a private credit manager to manage credit in a default or a workout scenario that are not necessarily available in other asset classes. Often here, bond fund managers talk about the asymmetric risk in bonds and fixed income. It's only going to go down, and if it goes down, you're going to lose money. Or you see in the banks, they're faced with increasing provisions as a result of a deterioration in credit quality. Their answer to that is to sell the asset or to exit the position regardless of alternatives. And the reason for that is that the banks and bond funds are not necessarily in a position where they can enter into a debt for equity swap, as an example. So for a bank to convert their debt position to equity, they then are required to capital weight that asset at 400%. So it's punitive for a bank to hold that. And that's really designed to reflect the fact that the banks are highly levered and they shouldn't be holding equity positions on their balance sheet. But for a private credit manager, that's obviously one of the ways in which you would say, okay, I'm quite prepared to wipe out the interests of other equity shareholders and others to protect the interests of our investors and convert that debt to equity and at a later stage consider a restructure of that asset. So I guess when we think about our process, it really is very much about that investment that we've made in direct origination. So the ability to have direct relationships with companies, build and invest in those relationships, gain access to real-time private side information to assess the risk and to be able to monitor that. I would argue that as a private credit manager that's investing across a whole range of industries and sectors, that I would say that we have access to information well ahead of others in the market. Our clients are telling us exactly what's going on in their business every day. We're using that information to assess the ongoing risk associated with investing or providing financing to those companies. So if you think of it as an example, pre-sales that are occurring today in, say, a residential high-density apartment are most likely not going to be reported in any official data until after completion of construction and after the settlement of those contracts have been achieved. We're privy to that information today. So we have real-time access and information flows that inform our investment decisions. And so again, that process of origination, building long-term relationships with our investee companies and management teams, we do that on the belief that investing in relationships, building rapport, understanding those companies that we provide financing to leads to better investment outcomes. And so through that origination process, ongoing ability to structure and negotiate appropriate terms, and then ongoing management of those loan assets through compliance certificates, regular monthly reporting, P&L, balance sheets, cash flows that are coming through each month in terms of understanding the position, are important in terms of monitoring and managing risk. But when we think about, again, the Australian market, Australia doesn't have the same excesses as you have had in other markets. So when you think about a lot of the loss rates in private debt, often what is being reported is the US market. The US market tends to be a double B to triple C market in terms of high yield or highly levered positions. In fact, once it goes below CCC, they take it out of the high yield index. But there are some managers that I've seen in the US that comment and report the fact that there's been an absence of CCC credit that's impacted their ability to generate returns. The Australian market, where you've got probably around 100 banks that are participating in the market as a whole, really lend from A to BB in terms of credit quality, and that's the kind of asset mix that we provide investors with through our various funds. Again, it's really important to recognise and understand where you sit in the capital structure. At the end of it, you're investing in equity to see growth in earnings, growth in value. You're investing in debt to get the benefit and protection through equity. So combined with where you sit in the capital structure, combined with covenants, controls, the taking of security, are designed to protect the interests of a lender and therefore investors in our funds. And I believe, not only do I believe that the asset class is very attractive in the ability to protect and preserve investor capital, but I also am of the view that a large-scale manager that can provide greater diversification, where you're lowering the risk to any one individual counterparty, is a further way in which you can reduce investment risk. So in private credit funds, if you're in a private credit fund and you're in a highly concentrated credit fund, you've got a lot more risk than being invested in a well-diversified, large-scale credit fund. The area of weak governance is often used as a criticism of private credit. I can only talk about Metrics experience. Our processes require us to be compliant with Australian continuous disclosure obligations, ASX listing rules. And as a result of that, we have an independent responsible entity or trustee in the form of Perpetual. And one of the ways in which they ensure that we are compliant with the obligations around continuous disclosure obligations is that they've appointed Ernst & Young to do a monthly valuation and impairment testing across every asset in our portfolio. If there's any deterioration in credit quality that would impact the carrying value of the fund, it needs to be immediately reported. So again, these are the checks and balances across our funds. KPMG undertake a half-yearly and an annual review process. I accept the fact that we may not be able to be transparent in relation to the holdings that we have because we're subject to confidentiality obligations between a lender and a borrower. But what we can explain is the process and independent assessment and overview and governance regime that we operate under to ensure that investors can be comfortable that when we quote a daily NAV, the process has rigour and it's a robust process. Mercer Sentinel undertakes an operational risk review on an annual basis. S&P, we're one of the only funds globally in private credit that have S&P ratings on our funds. We don't use that to raise cheap debt financing, but what we do is we can highlight the difference when a company is borrowing money from a Metrics fund. They know the credit risk that they take when they borrow from our funds. So if you're building, for instance, a large-scale, high-density, 30-storey residential apartment tower, and each month you're going to put in your monthly drawdown request to finance the drawdown and pay the subcontractors. Good luck if you're borrowing from a private credit manager that cannot explain to you where their source of capital is and how they're going to possibly meet the monthly drawdowns. We saw that in the lead into the GFC, where private lenders failed to have capital available, causing problems in construction projects and the like. The ability of having a rated fund means that we're able to lend to very high credit quality counterparties. So for instance, we lend to Woolworths, Origin Energy, Brickworks, Ramsay Healthcare are examples. Most of those ASX publicly listed companies will say that their board-approved treasury policy says that they cannot borrow money from an unrated or a counterparty that has a rating less than a BBB minus or a BBB plus. And so that's a really important aspect in terms of gaining access. And obviously, the final piece in terms of governance, we have a range of relationships across the market with different banks that are privy to our portfolios on an ongoing basis. So it brings me to the final sort of criticism in terms of investment risk. Well, obviously all investments are going to have some degree of risk. I believe that in private credit, you've got a great investment asset class. Short-dated, floating rate, the ability to generate security or hold security. I think it's primarily an asset class for domestic purposes. I see a lot of people looking to invest in, say, US or European private credit funds. And the reality of it is most Australian private wealth clients do not need the complexity associated with tax, nor the risk associated with foreign currency to be able to gain an attractive return in private credit. But obviously size and scale is very important in terms of lowering investment risks, in terms of greater diversification of the portfolio, but it also means that when you are originating a transaction with a company, you're relevant to that company. You can provide the financing that is required to meet their requirements. Track record of the team, the strength and depth of the team are critical. We've now operated our first fund for over 11 years since we launched that first fund. Every single one of Metrics funds, we now operate over 21 different investment vehicles. Every single one of those has exceeded the minimum target return and delivered positive returns for investors month in, month out. And a focus of that is around appropriate risk management, making sure that you're lending on appropriate standards and that equity wears the risk of any loss. Obviously, we have workout skill set and capability. We're not a soft touch. Whenever we're negotiating a transaction, we're in there negotiating for and on behalf of our investors. What we're seeking to deliver is outcomes for our investors that are delivering stability of capital and a very attractive source of income. Just to put it in context, one of the things I read in the paper recently might have taken it. Maybe I'm a little bit defensive, but the position was, a criticism about Metrics real estate debt or real estate exposures, suggesting that all of the market in relation to real estate is going down the toilet. We, as an example, had no exposure to student accommodation in the lead into the pandemic. We've had no exposure to commercial office. Our primary areas of exposure in real estate are in residential and industrial development activities. Here's an example at Rhodes. We provided $130 million to that client, acquired the site, completed the demolition, excavation, converted our senior debt into a mezzanine position, and have now been fully repaid after the banks joined in the funding. Similarly, in North Sydney, this was a mixed-use hotel and commercial office component, built, completed now. Again, we provided acquisition financing, demolition, excavation, commencement of construction. The hotel was sold, the commercial office sold, and we've been fully repaid. I believe in terms of real estate-related lending, you're far better off lending for activities where you're going to be repaid from the sale of the asset. Obviously, it's a key thing to be able to provide financing, monitor the construction market risk and the delivery, but obviously what you're looking to do is have a known source of repayment at the time you enter into the transaction, and on sale and completion of the project, full repayment provided. So obviously there are a range of ways in which you can access private credit through Metrics funds. We have a range of ASX listed feeder funds. Really, the primary issue here is about providing investors choice around how you gain exposure to the asset class based on clients' risk, return and liquidity requirements. And then we have a range of different vehicles that allow investors to gain access, either daily liquid through the ASX or in unlisted private unlisted funds. And then obviously the various performance of the different funds. Now MXT has been operating for now over 7 years, and I think one of the things that probably is forgotten about our various funds, like when interest rates fell, one of the things that we did was we agreed to terminate charging any performance fees. We've now reduced the fees that are charged in MXT. When we first launched that fund, fees were around about 87 basis points. They're now down to around about 56 basis points. So there's been a number of things that we've done that I believe are very clear in terms of the way in which we interact with the market and the way we deal with our investors. And we're very proud of what we've delivered. So thank you very much for the opportunity to talk today.